I need to say I was surprised by the strength in the U.S. economy, but gold did what I asked it to do. It preserved my purchasing power. It was stability. Were there assets? Assets? Yes, like Apple, that did better. Would I have ever owned Apple knowing how little I know about it? No. What gold is for me is liquidity, a store of value, and insurance. So I'm very comfortable with the performance of my gold holdings, and I'm adding to them on a fairly regular basis.
Gold's price has gone up to its highest level in 2 months, which has made many people optimistic about its future performance. A survey conducted by Kitco News revealed that regular investors expect gold prices to approach $2,000 per ounce, despite the high likelihood of the Federal Reserve raising interest rates by 25 basis points in the upcoming meeting. On the other hand, market analysts are also positive about gold's prospects, but they're being more careful in their approach. Rick Rule, CEO of Rule Investment Media, stated that, "For me, gold serves as a way to have readily available cash, a safe place to store value, and a form of insurance." The Brics countries have been accumulating gold in their central banks, and there is speculation that they may be planning to introduce a gold-backed currency. Regarding this, Rule stated that the idea of a gold-backed currency is unrealistic, as there is no agreement on whose gold would back it, and redeeming such a currency for gold from other nations would be practically impossible. The US dollar has been the dominant currency in the global financial system for 80 years. But the conflict between Russia and Ukraine has led some countries to consider moving away from the dollar, and Russia and China are taking steps to reduce their reliance on it. This is because the US-led financial sanctions against Russia have made some countries question the safety of using the dollar. They are also concerned that the US could use the dollar as a weapon against them in the future. Rule believes that the US dollar's weaponization and low interest rates are driving other countries to seek alternatives. Rule believes that the US dollar is unlikely to collapse soon, but it's still a good idea to diversify your portfolio with other assets like gold. Let's watch snippets from Rick Rule's interview, but before getting into the video, make sure to subscribe our channel and give this video a thumbs up.
U.S. dollar will be the world's reserve currency, at least for the balance of my life, if not for yours. The U.S. dollar, for all its weakness, is relatively strong, which is to say, as good a job as we're doing destroying the U.S. economy, other governments are doing an even better job destroying their own. Our mutual friend, Doug Casey, once described the U.S. dollar as an I owe you nothing. He described the euro as a who owes you nothing, because there's a broader constituency. I think you need to describe the Brics as a nobody owes you nothing. Many of these are debtor nations. The idea that they back it without convertible currencies and in opaque markets that are thin is silly from the get-go. There's a discussion that this currency will be gold-backed. Whose gold? It will be gold-denominated, not gold-backed. And if you go to redeem that currency for gold, understand that the creditors have sovereign courts and they have guns. The probability that you will be able to go to Saudi Arabia or China or Russia and say, here's my brick, may I have some gold? That's just absolutely, positively silly. Now, in terms of the debasement of the U.S. currency, that's happening. But it isn't happening in Beijing. It isn't happening in Moscow. It isn't happening in Buenos Aires. It's happening in Washington. The weaponization of the dollar, the imposition of quantitative easing. We've talked about this before, Charlotte. Quantitative easing is counterfeiting. That's really what it is. It's counterfeiting. And the maintenance of deposit interest rates that are below the depreciation of the currency all are reasons, in addition to weaponization, why foreign countries believe they have the need to denominate their transaction in currencies other than the U.S. dollar, even if there isn't an alternative. So I think that those people who are looking for the near-term demise of the U.S. dollar, or even the demise, as overpriced as it is, of the U.S. Treasury market, will be disappointed. That doesn't negate the reason why you would own gold. It doesn't negate the reason why you would save and invest in other securities to diversify your portfolio. It's just that the U.S. dollar is the worst currency in the world with the sole exception of every other one.
After a pause in June, the U.S. Federal Reserve is expected to raise its benchmark interest rate by a quarter point to a range of 5.25% to 5.5%, the 11th such hike since March 20, 22. This would make it the most restrictive approach to monetary policy in 22 years, even though there have been signs of inflation slowing down recently. The Federal Reserve had implemented 10 consecutive interest rate hikes in a little over a year but decided to pause last month. This break was to give policymakers more time to evaluate the overall health of the U.S. economy and the effects of recent banking challenges on lending conditions. The move is part of the central bank's efforts to combat inflation, which has been cooling in recent months. However, there is still a risk of more rate hikes in the future, depending on how inflation evolves. Rule highlighted that the Fed may continue to raise interest rates, which could lead to either a rally in assets or problems in the housing market and consumer spending. Investors should be prepared for both possibilities. Let's watch Rick Rule's interview with Investing News.
The U.S. economy in particular continues strong, but the Eurozone economy too, particularly given the fact that there's at least a proxy war going on on their borders, astonishes me with its strength. You will notice in U.S. equity markets in particular that they're very concentrated on big tech. I don't want to comment on that because I don't know enough about big tech to know whether or not those valuations are real or not. But I will note that the length and breadth of the U.S. securities market has stagnated, while the market capitalizations of things like the Dow and the S&P 500 have had their gains really, truly dominated by monster tech. I think that the strength of the U.S. economy, and frankly, the purported strength in U.S. equity markets and the U.S. bond market, will allow the Fed to continue to tighten. And I think that the Fed has a genuine concern about inflation. Recent statements by Fed governors suggest that the Fed itself does not believe that Congress or the president will act responsibly with regards to the deficit or with regards to quantitative easing. And I think the Fed believes that the only chance that they have to fight inflation is through the discount rate, which I believe that they will be successful in increasing. Speculators then need to concern at least two possible outcomes. The first is that the Fed succeeds. I've never seen it happen necessarily before in my life, but there could be a first time. To the extent that the interest rate rises are measured enough that they really don't knock the economy for a loop, but they slow down economic activity enough that at least the CPI stated rate of inflation comes in less than the yield on savings products. With the amount of cash on the sideline, we could see a truly spectacular rally in various kinds of asset classes. I believe that's unlikely, but the truth is that speculators need to be open to all kinds of possibilities and probabilities. The second possibility is that the impact of increased interest rates will be a delayed punch, which is to say that we haven't felt it yet. One justification for that point of view would be U.S. home sales. The 30-year fixed mortgage rate has doubled. Buyers look at affordability and they're staying away from the markets, but sellers have price expectations that are 3 years old. The consequence of that is that we've seen volumes dried up. There's no match between the bid and the ask. Will that reconcile up or will that reconcile down? If we see, as an example, a dramatic price decline in resales of single-family homes, if we see dramatic reductions in the sales of consumer finance, consumer durables, as an example, or if we see a resumption of disintermediation of the bond market, I think that the political pressure on the Fed to pivot would be very high. The last real pivot I saw in my life was in 1975, where the Fed had succeeded in dramatically raising interest rates, cutting off inflationary expectations, but they also decimated the housing market and the stock market. And when they pivoted at the end of 1975, that set gold off on an epic route. I think investors and speculators need to consider at least both outcomes.
A Fed rate hike is likely to lead to a decline in gold prices. However, in the long term, the impact of rising interest rates on gold prices is less clear. If inflation remains high or if investors become more uncertain about the future, gold could still be a valuable asset. What do you think? With the Fed expected to raise interest rates again, what are the implications for gold prices? That's all from us. If you enjoyed this video, please like, share, and subscribe to our channel. Click the bell icon to be notified when we release new videos. Currently, only 96% of our viewers have not subscribed to our channel. Our goal is to reach 1,000 subscribers as soon as possible, and we cannot achieve this without your support. Please consider subscribing to our channel and helping us reach our target. Your support means a lot to us.